Well, I think that we'll get started. Welcome everybody and good afternoon. My name is Kirsten Slaughter and I am the chapter and education organizer for Wisconsin Farmers Union. Thank you for joining the WFU Winter Meeting Series as we look closely at the challenges around meat processing in Wisconsin and possible solutions. Today we will be talking about cooperatives and financing. Wisconsin Farmers Union is a member-driven organization and is committed to enhancing the quality of life for family farmers, rural communities, and all people through educational opportunities, cooperative endeavors, and civic engagement. Meat processing was selected as a special order of business for 2020 by our members. As we examine this issue, we look at it through the lens of the Farmers Union Triangle: education, cooperation, and legislation. Today, we are thrilled to have Kelly Maynard from UW Center for Cooperatives and Paul Dietmann from Compeer Financial. We'll have time for questions during the second half of this event. First, we'd just like to cover a few housekeeping things. This event is being recorded and we'll share this on the WFU YouTube channel so that it's easy for you to listen to again and share with others. You will be sent an email when the recording is uploaded. We are excited to hear from you about the questions that you have. You can ask them by clicking on the Q&A button on the bottom of your screen. Again, if you move your mouse around, you will be able to find the Q&A button and can submit questions by clicking on it. We know that meat processing is an issue affecting people across Wisconsin, and we want to hear from you. We want to collect as many short stories as possible from farmers and processors so that we can share the full impact. You can do this by following the link in the chat. Finally, you can learn more about processing and the work that WFU is doing on our website. At this time, I would like to turn it over to our speakers. Each of them will have a chance to introduce themselves and spend a little bit of time talking to us. We'll have each of them speak first, and then we'll be following it up with some questions. So I'll turn it over to Kelly first.
Thanks, Kirsten. Do you want me to introduce myself and talk, or give Paul a chance to introduce himself too?
Yeah, let's do just introductions first.
Okay. So my name is Kelly Maynard, and I'm a cooperative development specialist at the UW Center for Cooperatives, based on the UW-Madison campus, joining here from my home in Southern Dane County. Our center does a range of things related to co-ops, research, education, and outreach on the co-op model. We work in kind of across sectors and with all types of co-ops. And I specialize mostly in rural cooperatives, especially in the food system.
Thanks. And Paul?
I'm Paul Dietmann. I'm with Compeer Financial. Compeer Financial is part of the Farm Credit System, so we're a farmer lending cooperative. We're the Farm Credit System institution that handles about 2/3 of Wisconsin, the northern half of Illinois, and the eastern half of Minnesota. And we're one of the largest lenders to agriculture in the country. We're about a $25 billion entity at this point. My specific role here is I'm a senior lending specialist on our diversified markets team, and I co-lead our emerging markets loan program, which is a loan program for farmers who are either marketing direct to consumers or doing some sort of value-added processing. So I finance a lot of grass-fed beef operations, small-scale vegetable operations, CSAs, and things like that. And then a number of processing operations, including a few smaller scale meat processing plants too.
Great, thanks. And now I'll turn it back over to Kelly.
All right, let's see if this works. Is the screen share working? All right, cool. So just a few slides to kind of get us all on the same page. So a lot of you are probably Wisconsin Farmers Union members, and so may know this, but a cooperative is basically a group-owned business that is democratically controlled by the members of that group, and exists to meet their needs, and they are the ones who benefit from it, not some outside investors or Wall Street or someone else. Let's see. So structurally, a co-op is some membership, however defined, in the kind of thinking about meat processing, a lot of the folks who have thought about meat processing co-ops or are thinking about meat processing cooperatives are producers. The membership might be comprised completely or partially of producers. There are also some new examples of butchers being interested in being owners in this space. So in that case, it would be what we would call a workaround co-op, the employees of the business making up that membership. They, depending on their size, a subset of them is elected to be a board of directors that is kind of overseeing, not nitty-gritty operations, but the governance, setting policy, overseeing a manager or management who does operations. And so, for folks who are, for producers who are experiencing these challenges, I hear a lot from people, I just want to produce the meat. I'm not a butcher. I'm not, I don't know how to slaughter, but the existence of this service is critical for folks who are producers. And so this is a mechanism for them to kind of take control, if you will, a little bit of the problems with the supply chain. So some examples of the model that we can maybe learn something from. The Livestock Producers Cooperative Association in Odessa, Washington. I'm not 100% sure if they are still functioning, but they started in 2015 and they were really focused on meat processing. Kind of a premier example is the Island Grown Farmers Cooperative in Washington State that formed, they formed in 2000. And by 2002, they were operating the first USDA inspected mobile slaughter unit in the country. So I think, the speakers last time around talked about mobile slaughter. So they were kind of some of the pioneers in this area. And then by 2003, they were leasing a cut and wrap facility and opened a retail store there and have their own brand called Northwest Homegrown. And they are an example of a fully farmer-owned co-op. The Bay Area Ranchers Co-op is a brand new example. They incorporated just in 2020. They had 16 founding members who are all, again, ranchers, producers in the kind of North Bay, north of San Francisco, that all have their own established markets. And so they are exclusively planning to do meat processing, meat slaughter and processing, no marketing. And I was able to speak to them in the fall, and they were in the middle of a fundraising campaign. They're trying to raise 1.2 million for their capital needs to hopefully open in 2021. And so hopefully we'll have good things to learn from them. I put Wisconsin Meadows up here. They're not a processing co-op at all, but they are a marketing cooperative for grass-fed beef, but an example from our home state. And it's worth mentioning April Prussia, who was one of the speakers in the last call, is part of a group that is actively working right now to form a co-op to do meat processing. And they are exploring a model that we would call it a hybrid or multi-stakeholder model, where both producers and butchers would be members of the co-op. And so they have both producers and butchers who are kind of in their steering committee moving the project along. So co-ops aren't like a silver bullet solution here. I wish there was for all the kind of meat challenging processes that folks are experiencing. Pros and cons. It's a way to build potentially a broad base of support early on, and whether that support is in the form of financial support or just helping kind of community support can be crucial. There's a lot of like, not in my backyard, people don't like to be necessarily near processing facilities. So community support early on can be really important. Obviously we know, it's the financial outlay is large and it can be risky, and there's not a lot of profit necessarily, big, small profit margins, right? So if you're going in with a group of people, you can potentially spread out that kind of investment requirement and the risk amongst the group, as opposed to like one person or a couple people taking that on. There are some sort of unique financing options out there for cooperatives. Groups like the Wisconsin Farmers Union and others are really, like the co-op model because they're a co-op. And so, there's a general sentiment of like excitement about and support for co-ops right now, which is good and certainly something to consider. But also, challenges of the model, because again, these are not cheap facilities to get up and running. And there may be very different ability of people to invest in kind of the initial capital. And, we talk about the kind of member equity investment to in a co-op, and oftentimes it's like this, it's similar or the same for all members, or maybe tied to the scale of your farming operation. But we do have an example even in Wisconsin of a facility that initially there was a thought that it might be cooperatively purchased and run, and the group of folks who were working on that project, one person had a much greater ability to invest than everyone else, and ultimately decided, I feel like I want more say for how much I'm going to be investing in this operation. And so ultimately, I think they're going to do local meat processing. It's the fact that they're a functioning facility serving local farms is great, but they ultimately did not go the co-op route. Again, as you think about raising that capital and what people's investments are initially, whether it's members or outside investment, and what they expect as a return, it's a challenge. Co-op or not, because this, again, it's an industry with tight margins. Another, critique of co-ops, whether in meat processing or any place, right, is that group decision-making can be slower. And so, making quick adjustments, quick pivots, like with COVID, or, sometimes that's harder. And I don't want to say that that's necessarily the case. A lot of the work that we do as Center for Co-ops is helping people have, really good processes and systems for decision-making. A lot of co-ops I work with say that ultimately they make really good decisions because of the group input that they have. And they can weigh a lot of perspectives, but, it's a group project. Group projects are hard. So definitely something to consider. Something that, and Paul will talk about this with financing. Something else to really keep in mind is that making something a co-op doesn't necessarily make it work. While, across types of businesses and everything else, the rate of success for co-op businesses is a little bit better than startups of other ownership types, but co-ops can still fail. And so that early feasibility work, if you're thinking co-op, whether for meat processing or something else, is really crucial. And getting support in doing that. We're fortunate that there are a lot of different funding mechanisms out there to help support feasibility work. There are some small funding available from Compeer. There's the Value Added Producer Grant from USDA. Sometimes you can get some we have in Wisconsin, the Wisconsin Economic Development Corporation right now is its leader is used to work at Organic Valley, and so it's very co-op friendly. And so sometimes, you know, they're interested in co-op projects, and so it's always worth seeing if they'll help support an idea. Yeah, and you know, again, really like taking the time to do a deep dive into the numbers, and you know, we all, I think, are scratching our heads a little bit, right? Because it's like we know there's need for it, demand for it, but you know, it's a little bit more complicated than if you build it, they will come, and so that, you know, thinking through the hard questions, trying to get numbers from existing facilities that might be of, you know, comparable size, thinking through some of the, you know, challenging labor questions, and really who you'll pull from from producers, both in your membership and even, you know, processing outside of your potential co-op membership is all key, really important research to do early on. So I'll stop there.
Great, thanks. And we'll have a few questions for you in a minute, but I'll turn it over to Paul now.
Okay. Well, I don't really have a formal presentation, at least for this first part of the program, but I wanted to maybe follow up on a couple of things that that Kelly mentioned. Because we finance some cooperatives through our work, and I'll tell you, you know, one issue that I run into fairly often when talking to co-ops, there's always this kind of struggle with a co-op. If the co-op is profitable, do you keep those profits in the co-op or do you pass them all through to the members? You know, and there's always that sort of inherent conflict. You know, the members feel like, well, the benefit of being part of a co-op is that, you know, we should be able to be more efficient and achieve greater profitability. And then we should benefit personally from that by those profits coming through. And what ends up happening sometimes is in the good years, the profits pass through to the members, and in the poor years, the losses end up kind of accumulating at the co-op level. And then when it comes time for us to step in and hopefully make a loan to the co-op, they don't have much equity on the balance sheet, or their working capital is really light, or there's some things that get in the way of us entering into a lending relationship in those situations. Another thing that Kelly mentioned, we do have, Compeer has some grants available. We have a business feasibility grant available to organizations within our territory that up to $5,000 that can be used for business planning. And we've made a few grants to groups of producers who looked at joining together to open a processing plant. So that's something, if there are folks listening in who are thinking about working together and want to know whether this is even a possibility or not, you know, that grant is available to help answer those questions. Kirsten, you sent a few questions ahead of time, and one in particular that struck me was a question about, even though we've seen this big increase in demand for processing especially in the last year, really since COVID, the demand for meat being purchased direct from producers has just exploded. And it's really overwhelmed our small meat processing plants in a lot of respects. But despite that, it seems like a lot of our plants are struggling to survive. And so why is that? I mean, you'd think that we have all these people that really need the service, and with increased demand, you would think that prices would go up. It seems to me like we almost have just enough competition among those small plants that it keeps their prices and their fees that they charge really below where they need to be sustainable long term. You know, and I just last summer I worked with a small meat processing plant. It's not one of my customers, but they asked if I could kind of help them go through their numbers and figure out why they're working themselves half to death and they're not taking anything home at the end of the day. And really the issue was that their fees are just too low for them to maintain the business. You know, their employees are being paid, they weren't paying themselves, you know, and they're working 60, 70 hours a week and not take anything out of the business. And they're at a point where they're starting to contemplate retirement, and they're saying, well, where are we going to get these people to take over this plant, or who's going to buy the plant from us? And that's a real struggle. And my recommendation after running through the numbers and doing a pretty in-depth analysis was that they really needed to raise prices across the board by about 15% to reach the kind of benchmarks that we'd like to see them hit. And they felt horrible about it. You know, they felt guilty about increasing their prices, especially at a time of COVID when everybody is struggling. And yet, you know, my argument to them was, if you're not sustainable in this business, and other processing plants aren't sustainable in this business, then it affects all of the small farms that are trying to market by having their animals processed through your plant. You know, so it's really for the good of the entire industry, you have to raise your prices. Don't feel guilty that you're trying to put more money in your own pockets. You have to be sustainable, and the whole industry has to be sustainable. You know, it doesn't do the producers any good if their prices are low, and the way that they're managing that increased demand is by just scheduling shackling space out, you know, 2 years in the future. You know, I'm hoping that more of the processors are starting to manage demand by raising their fees a bit. You'd asked about cash flow, you know, struggling with cash flow and getting those plants to be profitable. And cash flow and profitability are really two different things. And raising fees would actually handle both of those things. Cash flow is really about cash coming in every month that then is covering all the operating expenses, labor expenses, making loan payments, providing an owner's draw. And so it's all about cash in, cash out. Profitability is looking at the financial return of the business, and is that financial return enough to justify the investment of the owner's money in that plant, and also their investment of time in that plant. You know, and so the financial return has to be enough to justify that. What we see is a plant that's been in business for a really long time, they may not have any debt. And so, so the cash flow of the business might be just fine to keep them going. But when it comes time to retire and they want to sell that business and they want to cash out of it, that new person coming in has to be able to buy that business and make it a going concern. What happens is the older generation never figured out that the business probably wasn't profitable for the last 5 or 10 years. They just never sat down and figured it out because the cash flow was okay. But that new person coming in, they have to look at it from a profitability standpoint. Can I take money and invest it in this plant and generate a reasonable rate of return? And if I can't, I'm going to go do something else. I'm not going to buy that plant. So, so that's really kind of a conflict that we have right now.
Thanks.
Maybe I'll stop there and we can open it up for questions.
Yeah, that sounds great. Remember that people can add questions in the Q&A button at the bottom of your screen. We've had a few come in, and so I think we'll get started on the questions. The first one, Kelly, I guess for you, if there is a group that's interested in looking at starting a cooperative, when do they go to the UW Center for Co-ops, or what are things that they can look for if they wanted to get some help?
Sure. You can come to me at any point. Come today, virtually. So yeah, I mean, I work with groups. We field a lot of calls where it's like, one or a few people have a co-op idea and they have no idea where to start. And so, we provide some resources. We talk on the phone. We, send them away with some resources and so maybe some guidance about how to pull together a bit more of a group that we would call like the steering committee to move the idea forward. So a lot of the work that I do is early phase stuff. So starting with a small group, starting with a steering committee, like what does it mean to be a co-op? How do you file articles of incorporation? What are the bylaws? And providing some support while they also do the work of like feasibility, assessing feasibility and things like that. And then, I don't disappear, stick around for, co-ops as they're, get up and going, operating. There's always a kind of a a governance transition between like all the planning work to then when you kind of open the doors in whatever way that means. And then our center provides kind of ongoing, director training opportunities and things like that. So our website has a lot of resources on it. If you don't feel like wading through them, you can reach out to me and I can point you to some good starter ones.
Paul, kind of follow-up question related to that. So if somebody does have a strong business plan, what are some financial resources that they should be considering to support kind of the development of a new or expanding meat processing facility?
Yeah, well, there's really two ways to finance a business like a meat processing plant, and that's either with debt or with equity. Of course, I work for a lending institution, so we're providing debt capital to businesses. But equity capital is the other side of that. And that could be owner's equity. So it's the members getting together and each putting in a certain number of dollars, or it could be venture equity, or a lot of businesses in municipalities take advantage of public economic development tools to inject some equity into their businesses. And I think that's something that we need to look at more closely, because it's difficult to finance a meat processing plant. It's a plant that's located in a small town. A lot of times the real estate values are relatively low. And if I'm looking at making a mortgage loan to a business, I have to look at what the value of the real estate is, and I'm going to loan a percentage of that. And it may end up being that we're not providing nearly enough capital for that business to get up and running. So then you have to fill in with equity. And it's probably too much to ask the members, if there's 5 members of a small cooperative, to come up with $1 million between the 5 of them. You're talking about a lot of money. Well, if you were a business in a municipality, and it doesn't have to be a huge municipality. I live in the village of Prairie Sac, and yet we still use economic development tools like TIF districts, tax incremental financing districts, to help businesses get going. It's pretty rare to see that in a rural business like a meat processing plant, even though it's a tool that's available. But it takes a certain amount of technical expertise to use a tool like a TIF. Industrial revenue bonds is another one that could be available to rural businesses, but it takes a level of technical expertise to be able to use those. I have a small cheese plant that I work with that actually was, when it went through a pretty significant expansion, they used industrial revenue bonds to finance that expansion project. So there's tools available that we don't see them very much in rural businesses, and we need to, I think, do a better job of bringing those in, because the debt financing from an organization like ours, it only takes you so far, and it's the demand on cash, because I'm going to ask for regular loan payments of principal and interest. If we can get more equity capital into rural business, that equity tends to sit on the balance sheet for a really long time and doesn't need to be serviced until the end of an investment period. So we need to have more equity investment in small businesses like that.
Thanks. So I have a question for both of you, which you might answer differently, I guess, but if you could design a system that allowed cooperatives or processing facilities to succeed, what would need to be changed in order for that to work?
I don't know that this is like the vision, but one, Paul talked about how, pricing is, maybe really below where it needs to be for long-term viability of these kind of smaller scale facilities. And, one thing that one option, particularly if you've got a group of producers working together as a co-op, and they need the joint processing, but they're also like producing around similar, using similar production standards, grass-fed or organic or something, right? That would enable some marketing together. If an enterprise can like combine the processing, you know, if like the finances of the business are both like the processing and like some potential retail sales, right, that help maybe have a better margin and can like, you don't want the processing to be operating at a loss, but like if profit can come from another type of revenue generating thing like sale, you know, marketing of you know, a high-end product, then the combo of those two things maybe could be really successful. And that could be a, you know, an interest, you know, that the Island Grown co-op does that from the examples I gave. And, you know, I do think because there is this labor question, which is a big one, right? And so whether it's through a co-op or, you know, but that like early engagement of the people who will be doing the work, you know, really bringing those, I mean, the really pushing like for more, you know, trained butchers, but then also like having those people at the table, I feel like is, so, you know, enterprises that can do that and have, you know, a couple voices from those, you know, key points, the workers and the producers in the supply chain talking to each other and help, you know, maybe making decisions together. Maybe you get, you know, you get some creative solutions, right, that we're not even like thinking of right now.
Yeah.
Oh, go ahead.
Oh, I was just gonna say, yeah, I mean, I come back to the kind of the financing structure again, you know, and I guess in a perfect world, I would love to have, you know, a technical expert located in every region of the state that could work with the town in a or in a rural area to access tools like TIF or like industrial revenue bonds. You know, I think it's too much to ask. If you've got someone that wants to start a meat processing plant in Durand or somewhere, and it's in a rural township where you've got a part-time town clerk and a 5-member town board that are all volunteers basically, it's too much to expect that those people will know how to work with a bond council to create a TIF district. You know, but if you had, whether it's through the Wisconsin Economic Development Corporation or maybe it's Extension or maybe it's STACAP, but having a regional specialist who can come in and work with the township and say, okay, we've got this business that wants to get started. We've got producers that are committed to it. We realize that it'll provide some jobs. It'll provide economic activity in an area where we really need a lot of economic activity. Okay, here's the tools that we can use. And they're the tools that if you were in the city of Madison, they've got a staff of 20 people that are working on those tools every day. You can't expect that a small township has the same level of expertise or access to those things, and they need to. I mean, it's, you know, we've seen this gap between, you know, major municipalities and rural areas that's widened and widened, and we've got to be able to start pumping more economic activity back out to rural areas.
For Kelly, what percentage of co-ops are succeeding, if you have that number, or usually how long does it take for a co-op to become self-sufficient?
Oh gosh, succeeding like across all co-op types, and I don't know the statistic off the top of my head. I could probably look it up and send it along. You know, I think their co-ops, I mean, how long does it take to, you know, reach break even or profitability? I think co-ops are, you know, it depends on the sector, right? I mean, there's not necessarily a reason to think it will happen much faster than like another business type, you know, so usually it's on the order of, you know, several years, and it can be longer, you know, sometimes there's kind of overly optimistic, you know, projections about sales and sales growth, and those are, you know, in reality, a little harder to achieve. And so it takes longer, but, you know, several years, 3 to 5 years. I mean, I think similar to other small businesses.
Thanks. And Paul, so succession planning is not just an issue for farmers, but also for meat processors and butchers. What options do they have to assist in the work that it takes to successfully transition their business to the next generation?
Yeah, I think they face some of the same issues that farmers face when it comes to succession planning. It's the thing that it gets pushed off until you can't push it off anymore. And usually it can't be pushed off anymore when someone reaches a point where they can't handle the workload anymore. The difference is that if someone is farming and they decide that they want to exit farming, there's always going to be somebody that's going to want to take over that farm. Whether it's the neighbors renting it or someone buying it, there's always demand for it. The challenge with a meat processing plant is the person reaches the point of retirement and they want to cash out of it. They want to sell it to someone else. And there's no one that can come in if that business hasn't been profitable, like I mentioned before, where no one ever sat down and calculated rate of return on assets or rate of return on equity because the cash flow was okay. They never worried about it. But when they go to sell it and they want to cash out of it, now there's a buyer that's calculating the profitability of that business. They're looking at their Schedule Cs for the last 3 years and saying, okay, well, here's the most I can possibly afford to pay for this business. And it's a fraction of what the owner thinks it's worth. And what ends up happening then is those businesses, the owners limp along as long as they can, and then they just shut them down. I financed a meat processing plant a couple of years ago in Minnesota that was kind of like that. I had a grass-fed beef producer that bought this small meat processing plant in a local community there. I made him an intermediate term loan for the equipment, and he essentially got the real estate for free because it was a business that had been shut down. It was in town that was dying, and there was just no market for it. So it was great for him, but it was terrible for those people who put their heart and soul into that business for 40 years and ended up with nothing out of it. So really what would be ideal is someone is in the meat processing business, they're 50 years old, and they start grooming someone from their employee ranks to be the next owner of the business, and kind of help them understand how the business operates, how you calculate cash flow and profitability, how you manage your balance sheet. And then when they're ready to retire, keeping some patient equity in that business, so maybe the business is worth $1 million, and they come to me and I can provide a loan of 300,000 or something. Somebody has to make up a gap of $700,000. And if it's someone who's 25 years old, who's taken over that plant, and maybe they've got $50,000 of access to capital, somebody's got to hold the difference there, and so that's where, in a perfect world, every business would kind of operate that way in a transition over a period of time, 10, 15 years, helping that next generation come in. But unfortunately, it doesn't work that way. It's easy to get caught up in the day-to-day work, and you just don't think about that long-term planning until all of a sudden there's some catastrophic event that happens that it has to happen in a month,
I'll add one thing on this succession conversation, which is that our center does do work on cooperative conversions. And so to my knowledge, there are no examples of this in meat processing, but there are examples in other industries, and a number in Wisconsin, where sometimes it's upon retirement and sometimes it's not. The business is sold to the employees to become a worker-owned cooperative as a way of keeping the business going, keeping the jobs, et cetera. Again, it takes a lot of planning. It can be really challenging in a business where the potential new owners probably may not have a lot of equity sitting around to invest, and it might be a really expensive purchase. So then what Paul laid out in terms of like the owner helping, the previous owner helping finance it over time, things like that. All of those are important conversations to take place over a long time, but employee purchase as a co-op is an option.
There's a couple of questions I think about like cooperative structure. So there's one kind of asking how co-ops are organized, either as C Corps or LLCs. And then also any co-ops that are operating as a hybrid based off of like investment shares and the number of shares?
So in Wisconsin, every state has their own cooperative statutes. And so like in Wisconsin, we have Chapter 185 and Chapter 193. Chapter 185 is the statute that's been around a really long time, and most co-ops are incorporated under that. So when you form, you incorporate under one of those statutes. So Chapter 185 makes you a cooperative corporation. So you're not incorporating as some other business type and calling yourselves a co-op. You're incorporating as a co-op. And then what was the investment question?
I think it's around like looking at who is investing and then who gets a say. And then also like, how do you add revenue, like if you need to expand, and how would you do that as a cooperative for investment?
Sure. So co-ops have a mechanism available to them called preferred stock. And typically it's a investment mechanism, and preferred stock can be made available to anyone. So a member, if they had the money, could invest through preferred stock, but oftentimes the point of selling preferred stock is to raise money from people outside the cooperative. And there is like a whole process involved in that, and you'd have to work with a lawyer, and there's, you know, securities rules and things that you have to keep in mind. There are some nice exemptions for producer-owned co-ops around selling preferred stock that make it a little bit simpler than selling like another type of security. And so basically you have to kind of think through the terms of that. Typically preferred stock does not, it's an investment in the co-op without a vote, right? And so usually there's provisions where like preferred stockholders would get a vote on the case of like merger, consolidation, dissolution. But you know, in terms of like more regular things that the board is voting on, the preferred stockholders are not voting. And so, but, you know, you have to design the terms of that in such a way that it is attractive to people. And it's generally considered patient capital. There is a legal cap on dividends for preferred stock at 8%. Most co-ops who use preferred stock to raise capital end up offering, you know, 4 to 5%, and, you know, kind of keep it at the discretion of the board. So it's not, you know, you're not attracting people who are expecting like a big return. We have some more stuff on preferred stock on our website. Yeah, and I mean, I think, you know, a co-op, like any business, I mean, you know, assuming that there's some amount of profitability, a co-op every year makes decisions. The board thinks through every year, like, what do we do with that profit if and when we have it? And there is always the option to reinvest in the co-op. And, you know, for growth, for, you know, developing a new revenue stream, things like that. And so usually co-op boards are making at the point of profitability. The board is one of the big decisions they make every year is like, okay, you know, our members do want a little bit of return. So how much do we give back to the membership? And then like, how much do we save or, you know, reinvest? You know, and co-ops preferred stock is more often used in a growth scenario than in a startup scenario, because you've already proven yourself a little bit as a business, you have a track record. And so then it is easier to attract people to buy the preferred stock. And so that is a way that co-ops finance, like doing something new and growing.
Yeah, Organic Valley sold preferred stock for a number of years, probably the best example in Wisconsin. And it was pretty attractive. I think they were advertising like maybe 6% or something. I mean, it was.
Yeah. Equal exchange, you know, a co-op that not in Wisconsin that people, you know, they do preferred stock offerings fairly regularly. So yeah, absolutely.
We've also gotten a number of questions about like pricing, and if you are a processor, how do you set those prices? And then kind of how do you make the cultural shift that allows for prices and rates to increase? And is that tied to kind of profit in farming?
Yeah, well, I'll go back to the example I used before, the small plant that I worked with over the last summer, doing a financial analysis, and the way that they priced their fees was they just compared themselves to other processing plants in the kind of in the area within a 30-mile radius or so, which my feeling was they'd been in business a really long time, and some of the people they were comparing themselves to hadn't been, and their products were fantastic. They had a lot of people coming through the door every day buying out of the retail case, but they also had quite a list of producers who were having animals processed through their plant. And I don't know, my feeling was that by telling them they could raise their prices by 15%, I don't think that it would have cost them any customers at all, especially people who are marketing meat direct to consumers. They're in a better position to pass those fee increases along. And actually, I think a lot of them would love to pass those fees along if it guaranteed that they had the slaughter space. You know, if they could get slots for processing. You know, because that's really the biggest challenge we're having right now is that producers are having to book their slots out a year or 2 years in advance.
We're also getting a number of questions, I think, around the hybrid model that you mentioned, Kelly, and kind of how to bring together like workers and farmers, and kind of like what could be the benefits of that as a model, and if not, like if you haven't seen examples of that specifically in processing now, are there examples in other kind of sectors that would be helpful?
Yeah, sure. So yeah, and one of the questions about the model was like producer and consumer. So yeah, I mean, we are fortunate in Wisconsin that our co-op statutes are quite kind of broad and progressive and allow for this hybrid or multi-stakeholder model. That's not true everywhere. And you know, we have some examples in our state. Fifth Season Cooperative out of Wrapup has a 5 or 6 membership classes. Maple Valley, the organic maple syrup cooperative has multiple membership classes. We're starting to see some examples in the grocery space. So grocery co-ops are typically consumer owned, but now we are seeing some examples of co-ops that are consumer and worker owned. So, you know, in this space, I mean, I think part of it, you know, I saw a question up the list too, like it can be with producers, there can be a lot of energy at the start, but like, how do you sustain it over a long term? These projects they don't happen, and it's usually in a short time frame, and it's a lot of work. And, you know, part of I think that, you know, if you're in a like, you know, startup dream phase can be a good time to, and you're thinking multi-stakeholder can be a good time to like bring those people in early, because I do think that once you have kind of an established co-op structure and governance and way of, it can be more of a challenge to then like invite in a whole another set of stakeholders into that. You know, I think in this meat processing in particular, because we know that labor is such one of the tricky pieces of the puzzle, and that people want, you know, I feel like a lot of the producers I talk to who are interested in, you know, kind of locally focused meat processing, they want to create good jobs, right? I mean, you know, we heard the horror stories about meat processing facilities and COVID and all the things going on, and right, and they're interested in creating good jobs, right? And so, what better way to do that than to have the people at the table who would have those jobs, you know, and really give those people empower those folks who would be doing the work to be helping make decisions about the business. I mean, I think that worker-owned co-ops in general tend to have like less employee turnover across sectors and things like that. And so, and generally worker-owned co-ops tend to have slightly higher wages than different ownership structure businesses within a sector. It's, and so, you know, I think there aren't examples yet in meat processing, but I think it's a tricky nut to crack, right? So if you can have a couple other perspectives, if you can have some other perspectives at the table, that being said, having multiple types of interests at the table it's always a little more challenging potentially. I always caution folks on the consumer. A lot of folks I work with are like, whether it's meat processing or other types of co-ops are like, the community is excited about this idea. We should have a community class, consumer class, and I caution people about that because I think it's like, can you create mechanisms for community to support the project financially or otherwise without them becoming owners of the business? Because I think, and I encourage groups to ask the question, is the consumer so driven to be part of this project that they're gonna be making, keep showing up, keep coming to meetings, keep participating in the board, is it really vital to their existence, their livelihood in a similar way to the people, the producers, the workers, et cetera, right? And so that the consumer piece, grocery co-ops are consumer owned, right? But that the consumers need and want the store for, and so blending in consumers can be tricky, but that doesn't mean that you can't create mechanisms for consumers to, you can sell the preferred stock, right? You can do other sorts of community raises. And so these are all kind of questions that I really encourage groups to grapple with early on if they're considering a multi-stakeholder model.
Yeah, maybe to build off that a little bit, Kelly, here in Wisconsin, since 2014, we've had the ability to do crowdfunding.
Yeah.
Business that's located in Wisconsin can do crowdfunding from even non-accredited investors. So a non-accredited investor could invest up to $10,000 in a local business, and that business could generate as much as $1 million by pooling capital from small scale investors like that. But that tool has been almost not utilized at all. If you go, it's managed through the Department of Financial Institutions, and if you go to their website, it lists the number of businesses that have put out offerings under that crowdfunding platform, and they're all either breweries or multifamily real estate investments or something. I haven't seen any that really are working with an agricultural business or a cooperative grocery or whatever.
Yeah, I think this is an example. I remember sitting down with you a couple of years ago, and you talk poultry processing, and you brought that up to me then, and I've explored it, and I think it's again kind of like it's one of those things where it's like it's not super well known. People don't understand it, and I admittedly also it's not like it's a something that it's like we need to the folks of us who are working in business development, whether co-ops or not, in kind of food system, we should all sit down and have a group education webinar about it, so that right, because why not utilize it? I don't know.
Yeah, I've never quite understood why it hasn't been used. To me, it seems like a great idea, but there must be some barrier to using it that I'm just not seeing. I don't know what it is.
Well, thank you both for this information. I want to take a little bit of time now if you have any kind of closing remarks that you want to give to kind of summarize what you've said, or if there's anything else you want to add. Paul, do you want to start with you?
Yeah, actually, Kirsten, would you mind putting up those couple of slides? It's just kind of a summary of some of the things that we've talked about. Yeah, if you just want to click through. So this is that crowdfunding platform that I mentioned. It's through the Wisconsin Department of Financial Institutions. And there's a lot of information out there, but a business that's located in Wisconsin can raise up to $1 million through crowdfunding. And if they're an audited business, they can raise up to $2 million. Not accredited investors can invest up to $10,000. And a non-accredited investor, well, an accredited investor is typically someone who's got like $1 million of liquid net worth and has $250,000 a year of income or something. I mean, you have to be fairly wealthy to be considered an accredited investor. So it's nice that a non-accredited investor, somebody who isn't extremely wealthy, can invest in a local business if they really want to support it. You can go to the next slide if you would. I mentioned tax incremental financing. That's a tool that's available in rural areas to support processing of agricultural products. Again, a tool that hasn't really been used very much. Industrial revenue bonds, those are managed through the Wisconsin Economic Development Corporation. It's kind of a complicated mechanism the way that they work. I've only run into it once, and that was that plant that I mentioned earlier. But it's the municipality issues the bonds, and because it's the municipality issuing the bonds, they become tax exempt. And then the bonds are sold to someone who then takes the proceeds and invests those in a local manufacturing business, and then generates revenue from that business. And that revenue is tax exempt because it was funded with these tax exempt bonds. But that runs through Wisconsin Economic Development Corporation. You can go to the next one. And then I saw in the comments somebody mentioned the niche market processor assistance network, but this is a fantastic resource that's available. It was a group of small meat processors that got together and started putting together resources, making them available to other folks. And one tool in particular that I've pulled off of this site, and I've used it a lot, and that's it's a financial planning spreadsheet that can be used for someone who is thinking about starting a meat processing plant. It walks you through all the things that you need to calculate. So really handy tool. So that's it. That's all. I just wanted to put those couple of resources up there as we close out.
Thanks. And Kelly?
Yeah, I wanted to mention, because Kathy Stetz sent a link to an article, one of the co-ops that I mentioned that was the Livestock Producers Cooperative Association, did shut down, but then because of the demand for meat processing and all the challenges that were occurring early on in the pandemic, I think they were able to reopen, or they were planning to reopen in June. This was an article from the spring. So, you know, they struggled, but maybe they're open again. Yeah, I would add that, you know, people should hopefully, Kirsten, do you send a follow-up that shares like contact information?
Yep.
Yeah, so you can share my email address and, you know, link to our website. You know, people should feel free to reach out with questions about co-op model. We're happy to answer as much as we can at the center, and, you know, certainly peruse our website. We have a lot of resources on there. Yeah, so I hope folks will be in touch and keep asking hard questions. You know, co-ops, obviously I believe in co-ops, that's what I do, but they're not easy either. So we provide as much support as we can.
Well, thank you both so much. I really appreciate you being on today and answering questions and taking some time to talk about this. This is such a big issue in Wisconsin. I'm going to drop some links in here for folks. Just as a reminder, this series continues. In February, we'll be talking about policy, both state and national. So a question about consolidation. We'll be definitely talking a little bit about that. In March, we'll be talking about the labor issue. And then in April, kind of looking at the marketing side of things and looking at some creative solutions there. So thank you all for joining us today. Thank you to our panelists again. And we hope to see you again in the future on one of these calls. So thanks all.